So look, right now with high home prices and high interest rates, buying a home seems very out of reach for many people. But there's this one sneaky loan program called an Assumable Mortgage that might be that window of opportunity that you're looking for. However, there's one catch nobody talks about, and if you don't know about it, you might end up in financial trouble if you pursue this option. So in this video, I'm gonna break down exactly what an Assumable Mortgage is, how it works, what you're not told about, and what you need to consider if you want to go this direction.
When it comes to the average U.S. home buying experience, most Americans follow the same process. A buyer approaches a lender to get pre-approved for a mortgage. When the buyer settles on a home, they use their own mortgage to cover the cost at a fixed rate. The home buyer then pays off that mortgage over the term of the loan, normally 15 or 30 years. What an assumable mortgage offers is the option to take over the seller's loan. So instead of taking out your own loan at a new rate, you inherit the remainder of the seller's mortgage at whatever rate they took it out at. So a home buyer that took out an assumable mortgage in 2020 could offer an interested home buyer a sub 3% mortgage rate.
So what is an assumable mortgage and why is it such a great deal? I mean, it really is a great deal if you can fit into the tiny little box that's laid out. Here's the way it works. You get to take over a seller's existing mortgage terms, their current interest rate, which might be 2 or 3%, their current monthly payment, and the remaining repayment period. So let's say that seller has a 2.875 that they locked in 2021, and now they want to sell their home. If you qualify to assume that mortgage, you get that 2.875 instead of taking a market rate, which as of today could be anywhere from 6.5% to 7%. And that's exactly why these loans are so attractive. Mortgage rates have gone up substantially since the lows during the pandemic. I mean, I was helping people get mortgage rates in the low 2% range. As of today in 2024, mortgage rates are hovering near 7%. That's 3 times higher than they were just 3 years ago. So let's talk about how they work, because they do sound very appealing, but they're not as easy to get. So if you're a home buyer shopping for properties and you're looking at different listings, the realtor who's helping the seller should identify if that seller's mortgage is assumable. And if it is, they should leave comments in the listing. So as a potential buyer, you know if you can assume that mortgage. That's step one. You got to identify which properties are assumable, and that's how you do it. It's got to be explained in the listing that you see online. The first tricky element of this process is that you cannot work with the lender that got you pre-approved. To assume the seller's mortgage, you got to talk to the seller's mortgage company and go through their due diligence process to make sure you qualify for their loan in order to assume that seller's property. You can't work with the company that you started your pre-approval with. That lender is going to have their own credit requirements, their own debt to income ratio requirements, their own maybe asset and reserve requirements. So they're going to put you through the ringer to make sure that you qualify. And because it's such a great deal, you got to be prepared to pay a little bit more in closing costs, usually to the tune of an extra 1% in fees to that lender. One of the most overlooked steps here is understanding which loans are assumable and which are not. The most common loans in America right now are conventional mortgages. Those are the ones given out by Fannie Mae and Freddie Mac. Generally speaking, those are not assumable. So right off the bat, most of the homes for sale are out of the picture. Jumbo loans, those are not assumable. Typically, there's only a handful of loan products that are assumable, and those are the government-backed loans, which are FHA, VA, and USDA. FHA loans are for primary residences. Anyone buying a primary residence can get an FHA loan. However, there are restrictions. VA loans are for veterans. If you've served and you're a veteran, thank you for your service. All those loans are eligible to be assumed. And USDA loans are typically when you're buying some land in a rural area. Those loans are assumable as well. Now, here's where it gets super tricky and a little frustrating for the average buyer who thinks they're ready to get that assumable mortgage. This is the biggest misunderstanding and challenge that I see with potential buyers. They think they can take over the seller's mortgage rate for the total purchase price, which is not the case. So let me give you an example. If the seller has a loan balance of $300,000 and their purchase price is $400,000, you can assume the mortgage payments tied to their loan balance of $300,000. But if they're selling it for $400,000, you got to come up with that $100,000 down payment. The reason why it's so tricky is because FHA loans, they only require 3.5% down. VA loans, they don't even require a down payment. You can get 100% financing. But if you're trying to get an assumable mortgage, you got to pay the difference between the seller's loan balance and the sale price. That could be $10K, $50K, it could be $150K. It is what it is. So if you're a home buyer and you were looking to put maybe 5 or 10% down, and that seller is trying to sell it for 50 or 100K more than their loan balance is, what are you going to do? So the two most common solutions I've seen are either that buyer gets some type of second mortgage, a line of credit, or maybe they do a 401K loan or borrow against their own assets, or they get a gift from their relatives or their family to help, and then, maybe they pay them back over time. I don't know. The reality is home prices are still at an all-time high. it's likely that that seller has a mortgage well below what they want to sell their home for. So as a potential buyer, you got to cover the gap. So now you know how they work. Now you know the reality. Let's weigh out the pros and the cons. The main benefit of an assumable mortgage is getting a super low interest rate. If you're lucky, you'll catch someone that has a 2 or 3% mortgage rate. And if you can qualify to buy that home and you can cover the down payment gap, man, you're in good shape. The drawbacks, though, are not all loans are assumable. You got to make a big down payment if the seller wants to sell for a profit. And you got to use the seller's mortgage company, whoever owns their mortgage, which might require some extra hoops and hurdles, and they're probably going to whack you with some higher fees. So here's a key takeaway. Assumable mortgages are great, but most people don't make it to the finish line. You got to be prepared. You got to know how to find them. You got to be ready to work with the seller's lender. You got to realize that there aren't a lot of loan options available. And last but not least, if you get to that last stage, you got to be ready to write a big check because the seller's loan balance is probably here, their purchase price is probably here, and you got to cover the difference with that down payment. So look, if you have questions about assumable mortgages or you want to understand what you qualify for, you want to understand your budget, reach out to me. My team and I will be happy to help you. We've been serving home buyers for the last 18 years. I've personally helped over 5,000 buyers and investors purchase homes around the entire country, and I'd be honored to help you think this through.